Hey money marvels, welcome back to Finance with Ronke, the channel where we break down personal finance, saving and smart investing so that everyday Nigerians can build real wealth. I am Ronke, an ex-banker, chartered stockbroker and investment banker. My passion is simple, helping you take control of your money and make it work for you. If this is your first time here, I'm so glad to have you. Don't forget to hit that subscribe button and turn on notifications. If you are a returning subscriber, thank you for always showing up. Now, let's get to the business of the day, how to calculate your daily interest in Stanbic IBTC money market mutual fund. Have you ever wondered how Stanbic IBTC pays you daily interest on your money market fund? Let me show you the exact calculation they use, no guesswork, no confusion, and I'll break down how your 1 million naira earns returns. Let's use by using an average return of 70% every single day. By the end of this video, you will know exactly how you should be earning, whether it's for 1 day, 1 month or 1 quarter. So let's get right into the business for today. So we need to understand the basics. What is a money market fund? It's a type of mutual fund that invests in safe short-term instruments like treasury bills and commercial papers. The fund pays you interest daily based on your investment amount and the current annual rate. So it's a low risk type of investment. So if you are the kind of we have different types of mutual funds. I've done a detailed video, and I'm going to link it in the description box. I've done a detailed video about all the different types of mutual funds that we have. But right now I want to talk about the money market fund, how they calculate the interest on the fund. So it's a low risk mutual fund. So we are using the Stanbic IBTC money market fund, and the rate is about 16.98 or something. We just to abbreviate it and use 70% per annum. So we are starting with an assumed investment amount of 1 million naira, and we are saying, okay, we assume that our starting date is January 1st, and the fund has a minimum holding period of 30 days, which means you have to hold the fund for 30 days before you can decide to pull out or to terminate the investment. If you decide to pull out, you are going to be charged. But any withdrawal after the 30 days, you are not going to be charged any penalty. So we are assuming that, okay, you are holding for 30 days. So let's assume for day one, let's say you invested January 1st on day one and at 17%. So you say 1 million naira times the 70%, then divided, because the 70% is a year, is per annum, which means you are going to be paid that 70% for the period of 1 year. And we have 364 days in this year days in this year. So you now divide by 364 days. So it comes to 467 naira 03 kobo. Let's say approximately 467 naira. So that is the interest you earn on January 1st. And the way the money market the mutual fund works, that your daily interest is added to your fund value. That means it compounds daily. So for day two, which is the 2nd of January, the interest you earned a day before will now be added to your 1 million naira, which is still your initial capital, and then times 17%. So you now say 1 million naira plus 467 naira times 17%. So for day two, you are going to earn interest of 467.25, and it goes on. On day three, the interest from day one plus the interest from day two and the 1 million naira you invested will now be your new capital, then times the 70%, which is the interest rate, over 364. So you are going to earn 467.4. So you see even though it's fraction, you see the difference. Then day four, your new principal will be the interest for day one plus the interest for day two plus the interest for day three plus your principal, which you started with, which is 1 million naira, then multiply by 70%, which gives us 467.25. That is your interest. You see the way it works. Your interest is working and you are earning interest upon interest. This is what is called compounding. If it's not compounding, if it's just simple interest, you get interest daily. But with a compounding interest, your money for day one is also working. The interest you earned on day two is also working. The interest you earned on day three is also working. So that is what is called the compounding effect in the world of finance. So if you now stay for 31 days, I just want to use an abbreviation, that is January 1st to 31st. So you are going to say, okay, that 467 naira 0.03 times 31. So the interest you are going to earn will be 14,478. So remember that day, every day of that month, those interests are working. So this is just an abbreviation. Then if you now look at it for a quarter, which is 90 days, 91 days, as the case may be, so you have 42,999.73. So let's assume that you are accumulating every quarter, just for simplicity's sake, so that we don't compound and we don't just use ambiguous figures and you get confused. Let's assume that you are compounding every quarter, and the last quarter is March, the last day in March. So by the 1st of April, your interest that you have earned for the first quarter, January to March, by the 1st of April, which is 42,009.73, will be added to your initial 1 million naira interest by 70%. So from 1st of April, you will no longer be earning 467. Your interest has moved up to 486.80. Do you understand? So that is what the interest you will now be earning in second quarter, because all the interest that been earning from January, yeah, is making your principal to grow. You are not just still at that 1 million naira, you are compounding the interest. So by second quarter, so your interest from 1st of April has already grew to 486.88. So at the end of the second quarter, so if you now multiply by 91 again, so you have 4,300 and 6.23 naira. So that's the interest. Then by the end of third quarter, if you are starting third quarter, so you've already earned interest for first quarter and the second quarter. So you add it to your principal, which gives us that means you'll be having about 1,086,805.90. So that is your new principal. So you are not still at that 1 million naira level. So if you now do that and then you find the 70%, so your new daily interest is going to be 507 naira 57 574 naira. That will now be your new interest every day. So what happens? What this means is that your daily interest is added to your fund value, it compounds daily, and the longer you stay invested, the higher your return, your total returns. But if you withdraw before the 30-day minimum, like I said earlier, you may lose your interest for that period, and then you are being charged. But if you are able to wait, to still invest in that fund still after the minimum holding period, we have some funds that their minimum holding period is 14 days. We have some funds that their minimum holding period is 90 days. It depends on the fund. That's why I always advise people that read the fund, the fund fact sheet, so that you'll be able to know, so that if you don't know the minimum holding days and you decide to back out and you are being charged, so that you will not get to complain. So this is what happens. So your interest is working for you. It's just like a baby that is giving birth to another baby. The seed is giving birth to another seed. That is what compounding, and mutual funds help you to compound your money faster than any other fund. So the difference may look small at first, like the way we were seeing, you're like, oh, 400 naira, 500 naira. Yes, it may look small at first, but over a full year or if you are investing in larger capital, compounding adds up beautifully. And that's one reason money market funds outperform regular savings accounts. So now you know exactly how your fund manager calculates your daily returns. No guesswork, just simple maths. This is a disclaimer. The ideas and opinions shared in this video are based on my personal research and analysis. Please do your own due diligence before investing, because this is not a financial advice, but it's just for you to know how, when you invest in a money market mutual fund, how your interest are being calculated on a daily basis. So remember that past performance is not indicative of future results. Always consider your risk profile before making decisions. If this video helped you understand how your money market fund works, like this video and share it with someone investing, or with someone that is thinking of investing in mutual fund. And if you have any money question you want me to address in my next video, kindly drop it in the comment section. Remember, this is Finance with Ronke, where your money learns to work for you. Until next time, stay smart, stay consistent, and keep building wealth. Thank you. Please like, share, and subscribe this video to this channel. Thank you.